So this is part 2 of 4 of audit tips, and we'll be discussing the first half of procedures to reconsider. So now procedures to reconsider. Things that we're probably doing in an audit that we need to think about again. Agreeing sales transactions to a price list, dealing with components with negligible risk of material misstatement, prepaids for instance, badly designed analytical procedures, expense testing. Is there any point to it? The money's not coming back. It's a dead transaction. It occurred in January. What do we care? How could it be wrong? Journal entry testing. It's important to do this, and there could be problems that you could detect during journal entry testing, but if you do it mechanically, you're just going to end up with pages and pages of documentation, and you may well have missed the point. Going to talk about prepaids again, repairs and maintenance and fixed assets, testing repairs to see if they should be capitalized, review queries, are they errors in planning, supervision, or training, and purpose, procedure, and conclusion, which I see some people writing on every working paper, sometimes more than once. So transactions to reconsider, agreeing sales transactions to the price list, either in a walkthrough or as a substantive procedure. Now, the walkthrough is a walkthrough of the financial reporting system, so agreeing it to the price list is irrelevant. That's not part of the financial reporting system. And as a substantive procedure, how could it be wrong? The journal entry to fix it would be credit revenue. They've billed too low a price. And debit? Well, it was a January transaction. We're not going to be able to go to our customer and say, hey, in January we billed you too little. Here's an extra invoice. The customer would go, no. So credit revenue, debit revenue, I don't know. There could be no journal entry. There's therefore no point in the test. Maybe you say, well, no, we're doing this test so we can write the management letter. Now, writing a management letter is not the purpose of an audit. The purpose of an audit is risk of material misstatement, reducing risk to an appropriately low level. Could the client be annoyed if you write a management letter and say, hey, we did a bunch of transactions and found that you were not billing people enough and you should do something about it? Might the client go, well, I'd like to know how much time you spent doing that, and I'm not going to pay you for it because I don't want you to do that. I'm well aware of what's going on. So stop doing that and stop billing me for it. I don't want you to do it. I want you to do an audit. I don't want you to come in here and do a whole bunch of testing so you can write a pretty management letter. So think carefully about that. That's probably a test that you do not want to do, unless it's justified by risk of material misstatement for some reason. Negligible risk of material misstatement, and you got to think about that for an entire component. Prepaids, probably all the assertions are of negligible inherent risk. Perhaps it's an assertion. Valuation of domestic cash. Well, it's domestic cash. It's in domestic currency. Valuation is not an issue. For foreign cash, got to think about foreign currency translation, but that's probably not that hard to deal with. But for domestic cash, small client, all in your home country, valuation of domestic cash should be negligible. If it's negligible, we want to do only a very small amount of work, perhaps only brief analytical. Now, here is an example of how we might design an analytical procedure to give us a journal entry that maybe we can't make. So we've got a loan that at year end is $1 million. It varies a bit throughout the year. There's a variable rate between 3.5% in the year, and interest expense in the general ledger is $31,000 and some dollars. So the first way you could do your analytical procedure, you could say, well, okay, I'm going to estimate that the interest rate is 3%. So 3% times $1 million is $30,000. I found an error. I'm going to put that on the summary of unrecorded errors, debit something, credit something. The other way you could do is say, well, let me find out what the effective interest rate is. 31,000 divided by $1 million is 3.16%. I'm going to conclude that that is reasonable because I expected it to be between 3 and 3.5%, and it was. So if you tried to propose a journal entry, you would debit interest expense and credit payable to the bank. Well, the bank has charged all the interest they want. Debit interest expense, credit interest expense. We've made up an imaginary error that we do not know how to propose a journal entry to adjust. So I like the second conclusion, and the second way of doing a test is it's reasonable. And if we set an expectation for our analytical procedure, we're fine. So that's a better way to do an analytical procedure. Expense testing. And again, we've got to think about the journal entry that we're going to propose. So we're going to examine a selection of expenses for approval. Should we do 10 or 20? Oh, let's do 30. 30, oh, 40. 40 looks better than 20 or 10. Now they're dead transactions. So, what might we find? Well, we might find we paid an invoice and there's no purchase order. Debit expense, credit expense, don't know what journal entry it might be. Maybe that's an internal control point if it was clear that there should have been a purchase order, but there are some invoices where no purchase order would be expected. A utility bill, for instance, purchase order would only be expected if it was for raw material in a manufacturer. So maybe an internal control point. No journal entry, no point in doing that test. Well, how about classification? It's telephone when it's advertising. If you look at the income statement of a public company, they will have revenue, they will have cost of sales, they will have selling, general, and admin, they will have interest expense, long-term, short-term, depreciation and amortization, income taxes. They don't separately identify telephone and advertising. So in a very large company, debit expense, credit expense, I don't know. It's all within selling, general, and admin. Who cares? We're not going to find a risk of material misstatement. We're not going to find a journal entry to make. Fraud. So we find out that we paid the advertising manager, paid a buddy of theirs 2 times too much. And so it's a fraudulent payment. Debit fraud expense, credit advertising, again, all within selling, general, and admin. Better be sure it's fraud before you go rocketing off to management to say, we found the purchasing manager committing fraud by paying too much. Better be very, very sure before you do that. And anyway, we don't care. It's not fraudulently misstating the financial statements. It's fraud, by definition fraud, but doesn't materially misstate the financial statement. So what could you find? What is the test going to find? And what is the assessment of risk of material misstatement in planning before we charge off and do all this testing? Journal entry testing, and this is required, but we have to be very careful that we pay attention to what the point is and in fact respond to the risk of material misstatement that may exist in journal entry testing. So here is an audit program. We wish to determine the validity of journal entries. So I'm going to select 60 items randomly from throughout the year. I'm going to agree it to the approval by management on the journal entry form. I did 60 and they're all okay. My conclusion is all journal entries are appropriate. Now we have produced very pretty documentation. And I'm not sure what the validity assertion is. It's not one in professional standards. But it misses the point in standards that fraudulent financial reporting through journal entries is most likely committed at year end. So looking at it over the course of the year is perhaps pointless. And of course the entry is approved, so what? Looking for fraud by management and finding that management has approved the journal entry and finding that, oh, therefore it's okay, completely misses the point of fraudulent financial reporting in journal entries. So it's lovely documentation that proves nothing. Now, the fraud that started this was a public company that had sales of, I can't remember exactly, but the sales are about $60 million. And without any support or anything, management made a journal entry, debit accounts receivable, credit sales, $300 million. Far bigger than the actual recorded sales. There was no support, but it was approved. And then they went debit, property, plant, and equipment, $200 million, credit, repairs, and maintenance, $200 million. Nice round numbers, by the way. And again, no support, but it was approved. And I'm not exactly sure how the auditors missed this, but they spent, for instance, a lot of time on the $60,000 in sales and appeared, don't quite understand, appeared to have not noticed the $300 million journal entry. I kind of don't understand that. I think if I were doing the audit, I hope if I were doing the audit, I would have gone, where the heck did that come from? Because I would have been all year long expecting sales are about 60 million, and now they're 360 million, all by a journal entry at year end. What the heck? So professional standards were, of course, promptly modified, and it's not the best written standard, 240.33a. But let's read it carefully. It says, you shall test journal entries in the general ledger and others in preparing the financial statements. So journal entries that occur all year long and journal entries at year end in preparing the financial statements. The first thing you shall do is inquire about inappropriate or unusual activity related to journal entries. That should be automatic in every rep letter. And as I said before, asking management, have you committed fraud by doing journal entries? Not the world's greatest test, but that's required, so we do that. And if we read the standard, that must say that that's how we test journal entries in the GL, primary test. Because then the second thing we do is we select journal entries and other adjustments at year end and test those, and then consider testing throughout the year. So I asked in the rep letter, and I always do that, I looked at some journal entries at year end, allowance for doubtful accounts, some annual depreciation entry. In a small client, probably the client is not making any year-end entries in the preparation of the financial statements. We, the auditor, are proposing those journal entries, so there may be none, and we may already have looked at them. And then we need to consider whether or not to test others based on risk of material misstatement, and I decided I not to. So pretty simple response. Now, the other thing is we're looking for management fraud. And there is an enormous difference between fraud and fraudulent financial reporting. Fraud, the auditor does not care. Somebody stealing pencils from the supply room is defined as fraud. Theft is defined as fraud. But the auditor does not care, because that does not result in a material misstatement in the financial statements, does not result in fraudulent financial reporting. Inventory is corrected by count at year end. We don't care about fraud. Fraudulent financial reporting, something is done to make the statements wrong. We really, really care. And asking management if they have committed fraud is useless. They're going to say, even if they had committed fraud, actually they're more likely to say they haven't if they have. And looking for management approval of a possibly fraudulent entry is similarly useless. So if that's what our test is, I looked at the journal entry and it was initialed by the controller, $300 million, debit this, credit that, approved by the controller. I guess it's okay. We've got to be more alert than that and more inquisitive about a $300 million entry. Standards require us to ask, even though it's perhaps not the greatest procedure, we have to ask. Now the other thing is the word consider. How do we document considering? The dictionary definition of considering is I thought carefully about. First way of doing it is a checklist step, I considered. Standard said I should consider this. I did. Initial. You got to have a longer version. I carefully considered using my understanding of the entity. Now, carefully is redundant. I carefully thought carefully about is what that says. And of course you used your understanding of the entity. And if you decide I want to write a real long thing to fool the practice inspector, we'll talk more about that at the end, but that's probably not a good plan for a bunch of reasons. So number one's enough. Now there's other advice, A42, 43, and 44. All these paragraphs use the word may, which means the same as the word may not. So the auditor may not do this, the auditor may not do that, and the auditor may not do the other. And these are also not requirements. Requirements don't have an A in front of them. They are not requirements. They're helpful advice. They're something you might want to consider, but they're not requirements. So, year-end entries. Have we done enough? Have we done some? We need to conclude on that. Are there any large unsupported year-end journal entries? If there are, we really want to pay attention to that. And how do you be alert for an unsupported, even if approved by management, $300 million journal entry at year-end? If you spend your time paving the file with documentation, I think you're going to miss it. If you're considering throughout and there are no such large journal entries, that's probably all you need to do, and use judgment as to whether or not there are large unsupported journal entries. Now the other advice in standards is it says, hey, pay attention to journal entries that have round numbers. Depreciation is often recorded monthly in a round number, so that's not very good advice. This is like a bank that had done a study and found that bank robbers often wear brown shoes. And based on that, you issued instruction, treat all customers wearing brown shoes as bank robbers. That's as silly as saying treat all journal entries in round numbers as fraudulent. Doesn't work. Often fraudulent journal entries are in round numbers, but the opposite isn't necessarily true. Journal entries in round numbers are fraudulent. It just doesn't work. So that's the end of part 2, and thanks for listening. And please see part 3.